Welcome learners. I am Dr. Vikas Agrawal from Amrapali University. Today we are going to start our topic mutual fund and exchange traded funds. These are the important parameters for entering in capital market or security market. The basic learning objectives of this session is provide foundational knowledge of mutual funds and exchange traded funds, understand the operations, types, and growth of these investment vehicles. We have to discuss regulatory, taxation, and risk return dimensions on mutual fund and exchange traded fund. This lecture also enables students to become informed investors from various aspects. Understand how mutual funds and exchange traded funds are distributed in the market and how these schemes are to be evaluated. So, let's begin by exploring how these instruments function. In the last lecture, we explored market infrastructure institutions MII, such as stock exchange depositories, which form the backbone of our financial markets. Building on that foundation, in this lecture, we will discuss how mutual fund and exchange traded funds are operate within that infrastructure to offer investment avenues to the public. Mutual funds and exchange traded funds are collective investment schemes enabling individuals to invest in diversified portfolios. They democratize access to capital markets and are suitable for different investor profiles according to their risk appetite. This lecture also explores the functioning, types, benefits, regulations, and taxation aspect based on regulators' guidelines. So, let's begin by exploring how these instruments function, starting with mutual funds. Mutual fund is trust that pools the savings of a number of investors who share a common financial goal. A mutual fund is professionally managed investment vehicle. In other words, through investment in mutual funds, an investor can get access to equity, debt, bonds, real estate, gold, commodity, money market, etc. The significant feature of a mutual fund is that the contributors and the beneficiaries of the fund are the same class of people, named the investor. SEBI Regulation Act 1996 define a mutual fund is a trust that pools money from many investors and invest in various securities. The factor growth for mutual fund are investor base, return or market, and diversified investment avenues. The biggest advantage to invest in mutual fund is diversification by minimizing risk and maximizing return. We can say a mutual fund is a professionally managed type of collective investment scheme that pools money from many investors and invest typically in various investment alternatives like securities, shares, bonds, money market instrument, other mutual fund also, and other market instruments available for this purpose. The mutual funds will have a fund manager that trades, means buys and sells the fund's investment in accordance with the fund's investment objectives. The return from the securities invested by fund manager go back to the investors in proportion to their investment. How much the investor invest, they can get the return in their proportion. In short form, how mutual fund works? Number one, pooling. Investors contribute funds by purchasing units. First of all, investor contributes in the fund manager collect the fund. Second is investment. The AMC is asset management company, invest pooled fund as per scheme's objective. Every mutual fund have its own objective. According to that objective, the AMC invest in the fund. Number three, how can investor earn from mutual fund? There are three types of return. One is return from capital gain. If investor want to sell their units, he or she can sell and gain the profit. Number two, dividend. Mutual fund declare time to time dividend on share based mutual fund. And number third, interest or increased NAV. NAV is net asset value. According to the market ups and downs, the net asset value will increase or decrease. This also become the part of earning. And fourth is distributions. Gains are reflected in NAV or paid as dividend. Whatever you earn through mutual fund, either it may be declared as dividend or may be distributed as NAV appreciation, that based on pure market price. Nature of income distribution. There are three types of options available for an investor for their income. Number one is dividend option. Investors who choose a dividend option on their investment will receive dividend from their mutual fund. Suppose an investor invest in equity shares based mutual fund. So when the company declare dividend, the investor also gets the dividend in their proportion. Second is growth option. Investors who do not require periodic income, such as dividend or interest, he can go for the growth option. In this option, the income earned are retained in the portfolio of investor and allowed to grow rather than being distributed. Whatever income is he earn, grow as the part of dividend distributed. The third option is reinvestment option. Investor invest the amount of dividend, reinvest in the same type of mutual fund. In this option, the number of units held by the investor will change with every reinvestment. The amount of dividend again reinvested in that mutual fund. It will automatically increase the number of units held by the investor. The most important thing, what are the advantages of mutual fund and how an investor invest into the mutual fund. The major advantage of mutual fund is professionally managed. The fund managers who manage the portfolio, who manage the mutual fund are very much expert. They are expert to analyze in fundamental of company, or they have expertise in technical analysis. So mutual funds are managed by professional persons. Second is portfolio diversification. There are so many types of mutual fund. According to the risk appetite, an investor can choose the mutual fund. or portfolio diversification also reduce the risk of investor. The third is liquidity. Liquidity means easy entry and exit. Anytime you can purchase the mutual fund and anytime you can sell the mutual fund, especially in open ended mutual fund. Transparency, the NAV is available, daily NAV updates are available, periodic disclosures are available through asset management company. So very transparent. Affordability, low investment threshold, SIP option. You can purchase mutual fund through SIP at very low amount. You can also invest a lump sum amount in mutual fund, but for a medium class investor, SIP options are available. Systematic investment plans are available. Next is regulatory comfort. Mutual fund industries are governed under Security and Exchange Board of India and Association of Mutual Fund Industries of India, MFI. So these are the pillar, these are the regulators of mutual fund industry. Availability of different options. There are so many mutual funds available as per risk appetite of investor. There are so many mutual fund companies which provide tailor-made portfolio according to your risk, according to your need, according to your goal. They can make your portfolio. Tax benefit. There are various schemes which available in mutual fund industry who provide tax deduction benefit under section 80C of Income Tax Act. Growth of mutual fund industry. Mutual fund industry is continuously progressing. There is a roadmap from 2014 to 2024. Assets under management AUM rose from 9.87 lakh crore in June 2014 to 58.97 lakh crore in June 2024. And this is a major change in investment in mutual fund. The 10-year growth stand at 19.57 per annum compounded annually. The average return offered by a mutual fund is 19.57% per annum. Investor portfolios increased from 4.8 crore 2010 to 19.10 crore in 2024. Approximate 4 to 5 time increase. The total number of SIP account has crossed 1 crore in April 2016 and as on June 2023 it crossed 6.65 crore and it is increasing day by day. Key constituents of mutual funds. Who are behind of mutual fund industry? There are so many associations, there are so many industries, there are so many people who are behind the mutual fund industry. First is mutual fund trust. Mutual funds are constituted under trust, therefore they are governed by Indian Trust Act 1882. SEBI, Security and Exchange Board of India. Mutual fund industry in India regulated by SEBI under the SEBI Mutual Fund Regulations Act 1996. Primary regulator for mutual funds and exchange traded funds. SEBI ensures investor protection and fair practices in mutual fund industry. Next is AMFI, Association of Mutual Funds in India. AMFI promotes best practices and ethical standards to protect the interest of investors. Sponsors. Sponsors promote and establish mutual fund companies. Reserve Bank of India. Reserve Bank of India regulates money market mutual funds and oversees banking sector involvement. Board of Trustee. Board of Trustee appointed by sponsors to oversee AMC operations, ensure the AMC complies with SEBI regulations and protects investors' interest. Next is Asset Management Company. AMC manages the investment portfolio of the fund, make decisions on buying and selling the securities. Custodian safeguard the asset of the fund, handle settlement of trades and record keeping. Fund manager, this is the major player in mutual fund industry. He is professionally responsible for investment decisions and managing the portfolio of the fund. Registrar and Transfer Agent RTA, it maintains investors' records, handle transactions like purchases, redemptions and transfers. Distributors include banks, brokers and independent financial advisors. They help investors in purchasing of mutual funds and exchange traded funds. Depositories. Depositories holds mutual fund and exchange traded fund units in dematerialized form, facilitate buying and selling of mutual fund and exchange traded funds on stock exchange. In India, the two major depositories are NSDL and CDSL. The next topic is types of mutual fund. Basically, mutual funds are divided in two categories and rest of the category based on these two. First is open-ended fund. Open-ended fund. In open-ended fund, investors can buy and sell units of the fund at NAV related prices. NAV is net asset value at any time directly from the fund. These funds do not have a fixed date of redemption. It means you can purchase or sell mutual fund at any point of time. Next is close-ended fund. Close-ended funds have a fixed maturity period and are open for purchase only during the NFO period. NFO period is new fund offer period. Units are usually listed on stock exchange for trading. Next is interval fund. This fund is the combination of open and close-ended funds. Investor can buy or sell the fund only a specific time duration declared by the fund, so that it is called interval fund. Index fund. Index fund is also called passively managed fund by the fund manager. Replicate a specific stock market index like Sensex, Nifty or any other fund. The main target of this fund to match the performance of the index. Large cap fund. Large cap fund invest mainly in well-established large company which have a stable financial history. These funds are less volatile and suitable for conservative investor. Mid cap fund. Mid cap funds invest in medium sized companies that offer growth potential but These are riskier than large cap funds. Small cap fund. A small cap fund invests in companies with small market capitalization. These funds have high growth potential but also have higher risk and volatility. Next is equity fund. These funds invest in shares of the companies. These funds aim for capital appreciation and are suitable for long term investors with higher risk appetite. Debt fund. Debt fund invest in fixed income instrument like debentures and bonds. These funds are preferred by risk averse investors who are seeking regular income. Suppose an investor want regular income, so he can go for debt fund. Money market fund. A money market fund is a type of mutual fund that invests in short term, low risk debt instrument like treasury bills, certificate of deposit, commercial papers, etc. The basic aim of this fund is high liquidity and capital preservation with modest returns. Next is hybrid fund. These funds invest in both equity and debt instrument to balance risk and return. This is the combination of equity and debt. Suitable for moderate risk investors. Solution oriented fund. These funds are designed for a specific goal. Suppose a person wants to retire after 20 years, or maybe suppose a person wants to educate their children. So, this is solution oriented fund or maybe target oriented fund. These funds also have a lock in period and promote long term planning. Next is growth fund. Growth fund focuses on capital appreciation by investing in growth oriented stock. These funds are ideal for investors who are seeking for creating wealth over a time. Income fund. Income fund targets regular income by investing in interest generating debt securities. This is suitable for conservative investors. Gilt fund. Gilt fund is a type of mutual fund that invests mainly in government securities issued by central or state government. It carries low risk and also suitable for conservative investor. Next is tax saving fund. This type of mutual fund having a lock-in period. Lock-in period mainly the investor cannot redeem the fund within stipulated time period. Equity linked saving schemes offer tax benefit under section 80C of Income Tax Act. Next is thematic or sector fund. Thematic fund invest in a specific sector of trends. Suppose pharma sector, telecom sector, real estate sector. While index fund track a mark index, both cater to target investment strategy. This is also called a target oriented fund. Next is funds of funds. A fund of funds is a mutual fund that invests in other mutual fund schemes rather than directly in stock market. It offers diversification across fund managers' strategies or asset class. While it simplifies portfolio building, it may involve higher expenses due to layered management fees, so this is called fund of funds. Next is exchange traded fund or ETF. An ETF is a type of mutual fund that is traded on stock exchange like individual stocks. ETF tracks an index, commodity, or sector and combines the diversification of mutual funds with the liquidity of stock trading. So, this is the concept of mutual fund industry. In the next video, We will discuss about concept of exchange traded fund, types of exchange traded fund, features of exchange traded fund, taxation implications on mutual fund and exchange traded fund, channels for distribution available for mutual fund and exchange traded fund, and limitations of mutual fund and exchange traded fund. So that's all. Thank you.